The promotion had already been on his resume for 8 years when he realized nothing else had moved. The title had sounded solid when it first appeared in the email from Human Resources. Senior, permanent, full benefits. It came with a modest salary increase, a slightly larger annual bonus target, and a new parking space closer to the building entrance. At the time, his mortgage had been freshly signed, his second child had just started elementary school, and the household budget felt stretched but manageable. Stability was not just welcome, it was necessary. The company had a predictable compensation structure. Base salary increases were tied to annual reviews, usually 3% in a good year. Bonuses depended on overall firm performance. Healthcare premiums were deducted automatically. The 401k match was fixed at 4%. Everything functioned within a steady range. Nothing dramatic happened. Nothing needed to. Over time, that predictability shaped decisions outside the office. He and his spouse refinanced the mortgage when rates dipped slightly, extending the term back out to 30 years to reduce the monthly payment. The difference went toward childcare costs and eventually toward a used SUV when the first one aged out. They increased their contributions to the 529 plans slowly, one incremental adjustment at a time, tied to tax refunds and small raises. Each move felt responsible. Each one aligned with maintaining a balanced monthly cash flow. The house itself remained largely unchanged. The kitchen cabinets were the same as when they moved in. The backyard fence leaned slightly, but still stood. Property taxes rose gradually, as they do in most suburban counties. Home insurance premiums adjusted upward after regional storm claims increased. None of it caused alarm. It was absorbed into the routine. At work, the role solidified into something familiar. He knew the systems. He understood the politics. His performance reviews were steady. Reliable appeared frequently in written feedback. The firm valued institutional memory. He was invited to mentor younger hires. He trained new managers who eventually left for higher paying positions elsewhere. He noticed those departures but did not interpret them as signals. Each exit came with explanations: relocation, industry shift, startup opportunity. He had a fixed rate mortgage, children in school, aging parents within driving distance. The idea of restarting somewhere else felt disruptive. Stability had a gravitational pull. By his mid 40s, his base salary was significantly higher than when he began, but the increments had flattened. Inflation had outpaced the early projections he once made in a spreadsheet. Health insurance deductibles were higher. The grocery bill no longer matched the assumptions from 5 years prior. College savings balances looked substantial on paper, yet tuition estimates had grown faster than the accounts. His net worth had increased primarily through home equity and retirement contributions. The house appreciated moderately. The 401k balance rose during market expansions and dipped during downturns. He rarely changed allocation percentages. The automatic contributions continued regardless of headlines. It was a long-term approach shaped more by inertia than by strategy. The company restructured twice. Departments merged. Leadership changed. Titles were adjusted. He retained his position through both transitions, partly because he had been there long enough to understand legacy processes. His compensation adjusted slightly each time, but not dramatically. The newer hires entering at mid-career levels sometimes arrived with higher starting salaries than his current pay. The information circulated quietly among employees. He heard it, registered it, and returned to his desk. In performance meetings, there was appreciation for consistency. He met expectations. He rarely exceeded them in a visible way. Overtime hours were limited because evenings were reserved for family logistics, sports practice, homework, medical appointments. The schedule was calibrated to maintain equilibrium. The trade off was subtle but cumulative. By 50, the outline of his financial life was clear. Mortgage balance remaining 12 years. 401k. Substantial but not exceptional relative to peers. Emergency fund. 6 months of expenses held in a high yield savings account. College savings. Covering a meaningful portion but not the full cost projected. Car loans. None. Credit cards paid monthly. On paper, the profile reflected discipline. Yet income growth had plateaued in real terms. The last three annual raises had barely offset rising insurance premiums and property taxes. His professional skill set remained tied closely to the systems used by his current employer. Industry certifications he once considered pursuing had been postponed repeatedly. Travel for networking conferences felt impractical given the family schedule and limited discretionary funds. The realization did not arrive during a crisis. It surfaced in a routine benefits review meeting. The Human Resources portal displayed a retirement income projection based on current contributions and historical return assumptions. The estimated monthly income at age 65 appeared adequate but not expensive. It assumed continuous employment at roughly the same salary trajectory. It did not account for potential healthcare costs beyond employer coverage. It did not factor in supporting aging parents, which had recently become a recurring expense after his mother's long-term care needs increased. He printed the projection and placed it in a folder on the dining room table. It sat there for several days before he opened it again. Stability had required continuous alignment between income and obligation. Mortgage payments, insurance premiums, utilities, tuition deposits, car maintenance, medical bills, all calibrated against a paycheck that was predictable but bounded. Over time, the boundary mattered more than the predictability. His spouse had re entered the workforce part time when the children became more independent. The additional income covered extracurricular costs and supplemented retirement savings. It also introduced its own constraints: commuting time, professional clothing expenses, reduced flexibility during school breaks. The household remained stable, but the margin did not widen substantially. Friends who had changed companies twice in the same period reported higher compensation and broader benefits. Some had taken risks, relocating to different states, accepting temporary instability, enduring probationary performance cycles. A few experienced layoffs before landing elsewhere. Their trajectories were uneven. His was flat but continuous. He compared numbers privately. Had he moved at age 42, he might have reset his salary base higher. If he had negotiated more aggressively during one of the restructures, perhaps the compensation band would have shifted. If he had tolerated a year of uncertainty, maybe long term earnings would look different. None of those scenarios were guaranteed. Stability had protected against downside volatility. It had also limited upside acceleration. The house required a new roof at 51. Insurance covered part of it, but the deductible was significant. The emergency fund absorbed the cost, then was slowly replenished over 18 months. During that period, discretionary travel was paused. Contributions to the brokerage account, modest but consistent, were temporarily reduced. No single expense caused distress. The cumulative effect reinforced how tightly balanced the structure remained. At work, younger managers with specialized digital expertise began shaping strategic decisions. He participated in implementation rather than direction. Compensation differences widened quietly. His experience remained valued, yet not scarce. Replacement would be inconvenient for the firm, not impossible. The mortgage amortization schedule showed declining interest and increasing principal. That provided a sense of forward motion. Equity built slowly but steadily. Still, the monthly obligation anchored geographic and professional flexibility. Selling would trigger transaction costs and potentially higher property taxes elsewhere. Staying maintained familiarity but reduced optionality. He observed his own language when discussing work. Words like secure, steady, predictable surface frequently. Words like expansive, accelerated, or leveraged did not. Stability had become both description and constraint. Retirement contributions increased automatically when the company introduced an annual auto escalation feature. He opted in because it required no immediate decision. The take home pay reduction was noticeable but tolerable. Lifestyle adjustments compensated quietly. Fewer restaurant meals, delayed appliance upgrades, extended use of existing electronics. Healthcare premiums rose again during open enrollment. The plan remained employer sponsored, shielding the household from the full volatility of the individual market. Debt coverage reinforced his reluctance to consider employment changes. The perceived cost of losing it felt high, even though alternatives existed. His parents' medical expenses began to require more consistent support. Small monthly transfers supplemented social security income. These were not catastrophic sums, but they were persistent. Long term care insurance had not been purchased years earlier, when premiums were lower. At the time, other expenses had taken priority. In his early 50s, career recruiters contacted him less frequently. His profile remained active online, but the market targeted younger candidates for emerging roles. Experience was appreciated. Salary expectations were scrutinized. He sensed the narrowing window without naming it directly. The realization was gradual. Maintaining perceived stability had required a series of deferrals. Deferring skill upgrades, deferring salary negotiations, deferring geographic mobility. Each deferral preserved short term equilibrium. Over decades, equilibrium hardened into limitation. He revealed his Social Security earnings record one evening. The annual reported wages told a story of incremental increases, steady employment, no dramatic jumps. It was a stable arc. It was also a capped arc. College tuition payments began as the first child enrolled. 529 withdrawals covered part of the bill. The remainder came from current income and small draws from savings. Cash flow tightened but remained intact. The structure held. At work, succession planning conversations occurred without his inclusion. He was considered reliable in his current role, less so as a candidate for higher leadership. The firm valued continuity. He embodied it. The mortgage would be paid off at 62 if all payments continued as scheduled. That milestone felt significant. It also coincided with a stage when career mobility historically declines. The timing was orderly, almost symmetrical. He did not experience regret in dramatic form. There was no singular moment of crisis. Instead, there was recognition that stability had functioned as a long term financial choice with compound effects. It minimized shocks, it reduced volatility, it constrained expansion. Household finances remained solvent. Retirement projections were plausible. Debt levels were manageable. Yet, the income ceiling established years earlier persisted. The perception of safety had guided decisions more consistently than the pursuit of growth. On weekday mornings, he still parked in the same space near the building entrance. The routine remained intact. The systems functioned. The paycheck arrived on schedule. The mortgage balance declined incrementally. The 401k fluctuated with the market. The promotion remained on his resume. Nothing else had moved.